Welcome back. This is the part 3 of the AF3111 Intermediate Accounting 2 on the week 5 topic, other issues on leases. Just before this second break, okay, we've start looking at sales and leaseback from a point of view of the seller-lessee. We know that, right? The seller-lessee must in fact, let's go back. Must then debit the bank by selling this asset and then derecognize the assets, right? Asset derecognize, and then it could recognize again from a rights transfer when the selling price is bigger than the financial liability. And because of signing the lease agreements, right of use of assets has to be recognized, and then at the same time financial liability would be recognized as well. Right, now let's go back to the formula. We've just looked at it before the break. Remember, I teach you how to work out the rights of use asset to retain, right? That is based on what? Based on the financial liability at the commencement day, adjust for the artificial gain or loss, and then compare with fair value. And the reason we use this retain ratio is simple, because you sell something, right? Supposed to be sold at fair value, or above fair value, or lower than fair value. Okay, and then you lease it back based on all the rental, assuming that they are based on market rental, and then you discount them back to T0. So what you are now doing that is in fact by saying that, okay, if you sell it at let's say 100, but then you lease it back only for 80 after all the discounting, then in fact what that means is you would hold back or retain 80% of the asset for your own use. The rest of the 20% you would have been transferred or sold to the buyer-lessor. And that is basically how we interpret this retain ratios, right? And this retain ratio can help us to work out right of use of asset that supposed to be reported by the seller-lessee. Now, so we need to find out one more thing before we start looking at some example, which is the gain from the rights transfer. Okay, gains from the rights transfer. And again, we have a formula. But before we show you the formula, remember the gain from rights transfer is basically the difference between the total gains. Total gains would then be what? The book value of asset compared with the fair value. That should be the total gain if you're going to reporting it. So from a point of view of the uses of a financial statement, the total gain in any sales and leaseback transaction should be the fair value of the assets minus the book value of assets. So this is the total gains. And then you minus those gains on the rights that you have retained. And then the difference would then be gains from right transfer, which is the gain we're going to report. Gains on rights retained sounds familiar, right? Yes, indeed. Remember, we've looked at the formula to work out right of use of assets. That represents asset that we retain, okay, from a point of view of seller-lessee. So, in other words, you're going to see a very similar formula. So, to work out the gains on rights retained, which is in fact equal to the total gain, fair value minus the book value, multiplied by financial liability at commencement day, adjusted for artificial gain or losses compared with fair value. Indeed, that's the retain ratio. So if you want to work out the gains on the rights transfer, then that's the formula. Fair value minus the book value, which gives you the total gain, multiplied by the retain ratio. And then once you have this number, gains on rights retained, you then subtract it from the total gain. Now let's see how do we apply this. So I have 6 cases here, all cases having the same book value of asset equal to $100. Okay, and in the first 3 cases, financial liability equal to sales. Okay, equal to sales. So in this case, right, we do not expect it to have any gains on rights transfer. That shouldn't be expected. Okay, so this is why in the column F, must be 0. But then, what should be the total gain then? Total gain is fair value compared with sales. Fair value compared with fair value compared with book value. I should say fair value compared with book value. So fair value, the first one is 200, book value is 100, therefore 100 gain. And if fair value 150 in the second case, book value is 100, then it's $50 for the gain, and the final one is 250 minus 100, $150 gains. Okay, so in the first three cases, because financial liability is equal to sales, there won't be any gains on rights transfer. Then obviously, we don't even need to do calculation. The gains on rights retained must be the difference between the two, which is 100, 150, 150. Using the formula, we know it from the top. Of course, we can still work out the gains on rights transfer by ourselves, which is first of all work out gains on rights retained, which is total gain. Remember, total gain is the fair value minus the book value for the first one. Second one, fair value minus book value. Third one, 250 fair value minus book value 100. Now they are total gain. Multiplied by the retained ratio. Financial liability adjusted by the artificial gain or loss. Artificial gain or loss, remember, is what? Sales minus fair value, right? First one 0, second one 50, third one negative 50, which means a loss. A loss. Okay, so you then adjust them here. For the gain, you minus, for the loss you have back. The whole reasons we do that is because we want to reflect the market rental figures after discounting, right? And then compare it with fair value. 200 in case 1, 150 in case 2, and 250 in case 3. Then we have 150, 150. Once we have that number, remember, you can then simply use the total gain and then subtract that. Then you have a gain on rights transfer. 100 minus 100, 0. 50 minus 50, 0. 150 minus 150, 0. Okay, don't look at the formula for the time being. Okay, just listen, and then I will show you where is this formula coming from. Then we look at 4 to 6. In this case, sales in 4, 6, 4, 5, 6, they are all bigger than financial liability. So you should expect it that definitely there will be some gains on rights transfer. But what will be the total gain then? Total gain, remember, is always fair valued minus cost of the asset, CA of the asset. So the total gain would be for number 4 cases would be 300 minus 100, 200. Number 5 case, 250 minus 100, 150. And then fair value 350 for case 6 minus 100, 250. So we have these three numbers. Okay, let's then also compute the artificial gain and losses. Remember, artificial gain and losses compare sales with fair value. So for number 4, nothing. Number 2, 50. Number 6, 300 minus 350, 50 loss. Okay, let's apply the formula. The total gain is in fact what? Fair value minus CA. First one, 300 minus 100. Then number 5, 250 minus 100. Number 6, 350 minus 100. Okay, and then we plug in financial liability. Adjusted for the gain or loss. If you have a gain, you minus. If you have a loss, add. Divided by fair value. 350, 250, 300. Then you have 133 for number 4, 90 for number 5, 179 for number 6. Then remember, your gains on rights transfer would be simply applying the formula, right? If you know the gains on rights retained, which is this number, if you this formula here, and then if you know the total gain, which is fair value minus CA, the difference would then be gains on rights transfer. And we've worked out the total gain, right, in this column, right? So simply 200 minus 133, 67, 150 minus 90, 60, and then 250 minus 179, 71. Okay, now, some of you may notice that, in fact, there is a formula here to work out the gains on rights transfer. Do you want to know the formula? Some of you do, some of you don't. But for those that are curious, I'm going to show you the formula Okay, and they are not on your PowerPoint slides. Okay, let's go to that slides for illustration. And there you go. I'm going to show you the formula to determine the gains from rights transfer directly. And the way to do that is, remember in Formula 1, gains from rights transfer basically equal to total gain, fair value minus carrying amount, minus gains on rights retained, B. And we know in the Formula 2, gains on rights retained B is basically equal to total gain, fair value minus carrying amount multiplied by a retained ratio. Let's call it C. So Formula 1 is X equal to A minus B, and Formula B2 is B equal to A times C, right? So of course we know substitution, right? So if X is equal to A minus B, and we know B is in fact A times C, then we substitute it, right? So A minus brackets A times C, and of course we know A are common, we take it out, so technically speaking X would now be simply equal to what? A times 1 minus C, and we put it into our context in full. Basically what that means is at the end it should be fair value minus the book value, which is the A, multiplied by 1 minus the retained ratio, financial liability minus artificial gain or plus artificial loss, AL, divided by fair value. Okay, so this is the formula. Now, some of you prefer to remember this formula, and some of you just prefer to use the basic concept, i.e. follow the formula 2 first and work it out and then deduct from the total gain. Both are fine. Okay, so assuming that you don't have much problem now, let's then take a look of some question practices. Let's look at example 1. So we are now looking at example 1, okay, and there would be at least 2 examples to look at the seller-lessee sides of the sales and leaseback situations. Okay, in fact, in the first example, we will look at 4 subsamples within it. Okay, let's look at it. Okay, so you can see that Friends Limited has an asset with a net book value of 70,000, and the fair value of this asset is in fact 100,000. Okay, so and then we were told that it would like to enter into a sales and leaseback agreement. It has been offered of the following from 2 different banks in this case. So there were 2 banks, All In or Shore-Win. Okay, and so in this case what they would do is they would sell, Friends would sell the asset to All In and sell Shore-Win and then lease it back basically. So in the sales and leaseback agreement, you can see that the sales price for All In is 100,000 and the annual rental of 28570 for 5 years with an effective rate of 13.2%. And for Shore-Win, sales price 105,005, annual rental 27,700 for 5 years with a different rates. Assuming that the transaction occurs at the start of year 1, record the transaction in each of the case for year 1 for seller-lessee only, where the sales satisfy Hong Kong FRS 15 stop. Now, after reading the requirement, you know that you are now supposed to be recording this transaction as a sales and leaseback one. Why? How come you know it? Because you can see that you are supposed to prepare entry for seller-lessee, and we were told that the sales in fact satisfy Hong Kong FRS 15. So all the double entry you have learned so far can now be applied to this case. Okay, seller-lessee, right? Remember, in the case of the seller-lessee, we know it that in fact it sell the asset to All In first. To All In first is 100,000, okay, and then lease it back again. Okay, lease it back. So what should be the double entry then? Let's do it in 2 steps. If you imagine you are selling something, of course you would debit the money that you received, which is 100,000, and at the same time you removed the asset cost. So that's how you did it. Debit bank 100, credit asset 70,000. then you have to what? You have to credit the financial liability, which has to be based on the annual payment to 8570, 5 years 13.2%. So we will use this formula, 28570 times PVFOA, 5 years 13.2%. So happened to be equal to the sales proceeds, 100 and 100. Stop. Okay, now notice that I've highlighted two numbers, bank 100, which is the sales proceeds, and then the financial liability is also same, which is 100,000. What can you see from there? Well, remember, if financial liability and the sales figure, they are equal, then in fact there shouldn't be any gain from the rights transfer. Right? Just in case if you forgot, I will go back to that slice. This is the slice, right? When they were equal, sales proceeds and financial liability, they are equal, no gains or loss. Okay, so this is the case then. Let's then go back to that questions. And you can then see, in fact, the two are the same, and there won't be any gains from the rights transfer in this case. But then how about the ROU asset? Well, we have to use the formula. Remember, the formula is CA times the retain ratio. CA, we know it. Net book value, 70, times financial liability, 100. Do we expect that we have any artificial gain or loss? Well, to determine artificial gain or losses, remember you compare sales value, sales price with fair value, and they're the same. So that would be 0 artificial gain or loss divided by fair value, which is 100. And so happen that would be 70. So this is all balanced pretty well. No gain or loss whatsoever. Okay, so then after this, things would be easy because you now have a liability and you can work out the interest. 100,000 times 13.2%. You then have the interest expenses, right? And then you credit bank 28570. The difference is financial liability. Just in case some of you were curious, you want to work out the gains from rights transfer by using the formula, and to check whether the final the figures would then be 0 or not, you can substitute it, the information. Remember, the formula is total gain times 1 minus financial liability minus 0 divided by fair value. In other words, 1 minus retain ratio. Let's do that. Fair value compare with CA. Fair value 100, CA 70, which is 30. Multiply by 1 minus financial liability 100 minus no gain, no loss in terms of artificial gain or loss, and divided by fair value 100, and they are 0, no problem. Now, then depreciation would then be based on 70 over 5 years, so there will be 14,000. Okay, so basically that's how it works for this first cases with all in. How about sure win then? Sure win has a higher sales price, and then rental payment is lower, same durations, different effective rate. Now, do we know whether we have any gains from right transfer by looking at the numbers that we have here? Well, the answer is no. Why not? Because you must work out the financial liability figures first, as at the initial day, and then you compare with the figure. If you did not have that figure, you cannot conclude whether you have a gains from rights transfer. Okay, but do you have artificial gain in this case? Well, the answer is yes, because artificial gain is comparing sales price with fair value, and you should have an artificial gain of $5,005. Okay, well, this is just a little bit of recap before we move on. Now let's do it debit bank 105,005. Okay, and then we credit the bank assets 70, and then we work out the financial liability figure, which is 27.7 times PVFOA 5 years 10%. And so happened that it is in fact exactly the same. Of course, I make it up, and they are exactly the same, right? And when they were exactly the same, what does it mean? Financial liability equal to sales. That means no gains from rights transfer, so 0 should be. And then right of use of asset, remember we use the formula CA 70 times financial liability. And we know that there is an artificial gain, as I just pointed out, which is the difference between sales and fair value. So that gain had to be subtracted, divided by fair value, and that was 70. Again, if you want to test check this calculations of the gain from right transfer, you can do that. We have what? Fair value minus CA, fair value 100, CA 70, that gives you 30 times 1 minus the financial liability 105,005 minus the artificial gain of 5,005 divided by fair value. It is also 0, and they balance pretty well. Having this financial liability figure, you know the effective rate, you know the interest, which is in fact in this case 105.01 because of a rounding up, right? So 105.01, and you paid 27700, and the difference is financial liability. Okay, and depreciation over 5 years as well. Okay, let's continue with the questions, and now we have 2 more banks. All the details on the top on the first 2 lines are exactly the same, but now the 2 banks here, All Loss and the Deadlock, they are having 2 different prices here. Sales price are different, annual payments are different, discount rates are different. Requirement exactly the same. You're preparing entry for seller-lessee. Okay, now let's look at the first one for All Loss. Sales price is 125,000. Okay, and annual rental 30055, 5 years, effective rate 8%. Okay, stop. Do we have a gain on the rights transfer? Well, we don't know, right? Remember, we must determine the value of the financial liability first. Okay, do we have artificial gain? The answer is yes, we do have it, because sales price is bigger than fair value. Okay, right, let's start it. You sell these things to All Loss, receiving 125,000. Remember, you must removing the asset as well, which is 70,000. Now once you did that, you would then have to work out the financial liability figure by having 30055 times PVFOA 8% for 5 years turn out to be 120. Stop. Now we can determine whether we have gain from rights transfer now. Gains from right transfer, comparing sales with financial liability. If sales is bigger than the financial liability, we know that we have definitely gains from rights transfer. Well, where do we see this? Well, if we go back a couple of slides, then let me show you where we have that formula from. There we go. Here, when sales is bigger than financial liability, we definitely have gains from rights transfer. All right. Okay, let's go back to All Loss company in that example. There you go. So we did that. We have determined, in fact, that in this case there will be a gains. So we need to apply the formula. Now the formula is, you can do it 2 ways, and in here I would use that the easy way, just 1 step instead of going through 2 steps, i.e. have the total gain and then minus gain from rights retained. I do it in 1 step using that overall formula. So total gain fair value minus book value 30 times 1 minus financial liability 120 minus artificial gain. Artificial gain is, remember, 125 sales compared with fair value, which is 25 at the end. So 125 minus 100 is 25 divided by fair value. So it turns out that to be 1,500. And then for the ROU assets is the book value of the assets times the retained ratio. It's the same thing, financial liability minus artificial gain divided by fair value, 6,500. All right. So basically that's how it works. Okay, so by having the formula, in fact, we know how to determine this figures easily. And then, of course, when you have a financial liability of 120,000, you know the rate 8%. You can work out interest, and then you credit the bank. The difference is the financial liability, and ROU, of course, would then be divided by 5 years to work out depreciations. Okay, right. So now let's move on to the last one here in example 1. In this case, we have deadlock as the buyer-lessor, and you sell your asset to deadlock at 80,000. 80,000 as compared to the fair value. Obviously, we have artificial loss. Artificial loss. Annual rental 22,000, 5 years, 15%. So we will use those information to work out financial liability. Let's start with sales figures 80. Okay, and then we remove the asset by 70 as we expected, and then we work out the liability figures equal to 73,748 using 22k per year times PVFOA 5 years 15%, 73,748. Okay, right, so we have dealt with bank assets and financial liability, right? Do we have a gain? Now, of course, I show gain here, but you know it, how to determine whether you have a gain or loss, right? A gain means the bank sales proceed is bigger than financial liability. Indeed, we have a gain. So that gain, we will use the formula. Remember, the total gain, which is what? Fair value minus the book value, which is 30, times 1 minus financial liability, 73,748. And we know we have an artificial loss. We have to add back. How much? Sales minus fair value 20, so that is why we add back and divided by fair value 100, so we have 1876. And then excuse me, and then we would use the book value of the assets multiplied by the retained ratio, then we have the ROU asset. So I would not repeat that, basically just using book value times retained ratios. Okay, after that we use the financial liability figures here multiplied by 15%. We have interest expense, and then we credit bank 22,000, and we also depreciate our ROU asset over 5 years. So each year 13,125. Not that difficult, right? I hope you understand. Now, if you still don't get it, let's have one more. In this example, right, we have Q sells a building to C for cash of 2 million when its book value is just about 1 million. At the same time, Q enters into a contract with C for the right to use the building for 18 years with annual payment of 120,000 payable at the end of each year. A transfer of the building by Q satisfies Hong Kong FRS 15. The fair value of the building at the date of the sale is 1.8 million, incremental borrowing rate 4.5%, which is determined by Q. Stop. Okay, so first of all, we must know who is Q, who is C. It is quite clear from point number 1 and 2. Q is the seller-lessee, and C is the buyer-lessor. Okay? And in this case, it is obvious that we know there is a artificial gain. Artificial gain is comparing sales price with fair value. So we have an artificial gain about 200,000. Okay, do we have gains from rights transfer? Well, we don't know yet. unless we work out the financial liability. So you can see that I did a little bit of work here, and I've used 120,000 for 18 years, and then I used 4.5%. I work it out, the financial liability figure to be in fact 1,459,200. All right, we know the fair value of the building is 1.8. We know the sales price is about 2 million. Okay, right, book value is 1 million, and remember that in fact we know the artificial gain to be what, 2 million minus 1.8 as well. Okay, let's do the questions. Remember, you are now preparing the entry for the seller-lessee, which is Q, in year 1. Now in year 1, remember, you sell this asset for 2 million and you give up the asset and you de-recognize the asset by 1 million. So this is basically simple. Debit bank 2 million, credit the building for 1 million. So that can be done even if you have no idea about the double entry later on, right? Next is you're going to work out the liability figure, the financial liability, by discounting all that, and we know it is 1,459,200. Now we can determine whether we have a gain from rights transfer or we don't have it. It is clear that sales price is bigger than financial liability, you're going to have a gain. Okay, so how can we work out the gain? Then of course we use the formula, right? Total gain. Total gain is what? When the fair value, we know it, right, which is 1.8 minus book value 1 million is 0.8 million. So this is in fact total gain times 1 minus the retained ratio, which is the financial liability figures, minus artificial gain, which is 200, divided by fair value 1.8, which gives us 240,355. All right, and then we have one more double entry, the right of use of asset, which is CA of the assets times the retained ratio, financial liability figures, minus artificial gain, divided by the fair value. So we have 699,555. Okay, so the concept that we have applied so far all the way through are exactly the same as previously suggested. So remember, to determine the artificial gain, you compare sales with fair value, right? Then you have the artificial gain. Whether you have gains on rights transfer, right? The existence of gains on rights transfer, you compare sales with financial liability, right? And in this case, of course, you have a gains from rights transfer. So not to be surprised, you should have that. Okay, after this, you would use the liability figure 1,459,200 times 4.5% to work out interest, right? 65664, and then you credit bank 120,000, the difference financial liability. And you can use this asset for 18 years. So you would take 699,555 divided by 18, 38,864. All right. So over the years, each year. Okay, right. What I've done so far is I've gone through the at least 2 examples on the sales and leaseback transactions where the sales satisfy the definitions of Hong Kong FRS 15, and then we are reporting it from the seller-lessee perspective. Let's take another break. Okay, and after the break, I'm going to show you what would happen to the buyer-lessor sides of the accounting in the case of sales and leaseback.